So moving on now to chapter 2 in the book, we're looking at money management skills, and so we're kind of drilling down. And as I indicated last for our first week, our first chapter, our lecture was quite long, and I'll try to keep to it about a half an hour or so. At any rate, this is when we start getting into the details in terms of what it is that how it is, from a tracking perspective, et cetera, how it is we know where we're going and where we're at. Again, money management skills has to do with our ability to keep tabs on our money, meaning specifically we're looking at short term, but also taking out a step further and looking at longer term, our strategic goals. And so that's kind of what we're looking at in chapter 2, is trying to get our arms wrapped around what it is we're trying to identify, the sources of our funds, where we're getting our money, where we're getting our income from, what we're spending on, what our expenses are that we're incurring, and getting a handle on that connection between the inflows and the outflows in terms of the cash flow specifically, and also how to develop that wealth. So wealth, just a quick thought here, the difference between wealth and income. Income is what you earn over a period of time. Over a period of time, meaning what you earn in terms of like for an hourly wage or annual salary or monthly salary, however you're paid, that has to do with income. And the wealth is that portion of your income that you're able to retain, to keep going forward, if you will. So again, when we're talking about income and wealth, two separate things. Income leads into wealth, and it's the same idea. These are accounting. It's actually economic based, but there's a lot of economics in accounting. So when we start looking at income versus wealth, in accounting terms and accounting parlance, that's has to do with the income statement, the debits and credits, has to do with your income, your inflow with income, and your expenditures, that relationship between revenue and expenses. And I'm trying to get the economic or the accounting expressions in there as well. Anyway, the idea again is we're looking at income and what happens with that income in terms of the expenditures, and we're looking at wealth and how to gain that wealth in order to do what, to help you going forward in terms of being able to do the things that you want to do with your money, short term, long term, money management skills. Anyway, so once again, we're moving on, and it's money management skills, the chapter learning objectives, and learning objective LO 2.1, 2.2, 2.3, 2.4. 2.1 is identify the main components of wise money management. 2.2, create a personal balance sheet and cash flow statement. 2.3, develop and implement a personal budget. 2.4, connect money management activities with saving for personal financial goals. So this is, in this chapter, specifically we're looking at the tools that are involved in putting together our financial plan, what the financial statements are, what the financial paperwork, if you will, the electronically, spreadsheets, etc., all the things that we put together to kind of track our spending and so on and so forth. And at any rate, and 2.2, we are indicating a balance sheet cash flow statement. Basically what that is, that's an accounting term, balance sheet, where we have assets and liabilities, and the difference between the two is what's called is owner's equity. And what that means is that's kind of what's left over, your net worth, if you will. And after all of your, you take example, you own a home, and your home is worth $100,000, and you have a mortgage on that home, and you have a mortgage of $80,000 in that home. So your asset is $100,000, that home itself, the value of the home. And the liability, what you owe on that home, is $80,000. And so your equity, your whatever's left over, your retained earnings, is $20,000. So you have $20,000 ownership in a $100,000 home. That's kind of what we're trying to get at. So that's establishing, kind of talked about it earlier on when we talked about income and wealth. So the difference between the two: income is what you earn for a period of time. Again, wealth is what you, whatever's kind of left over after you receive your income, and whatever your expenditures are, whatever you have left over, that would be your wealth, how much you're able to set aside, the amount that you're able to save. And that has to do with the cash flow statement. So on an annual basis, for example, you're tracking your expenditures, much more closely than an annual basis, but we'll just say even on a daily basis, whatever your inflows is minus your outflows, whatever's left over, that is what is kind of added into your savings, if you will. So this is all in the process, or this is all part of the process of doing what? You're trying to establish a personal budget. You're trying to develop and, again, implement a personal budget. So the objective with this, of course, is to track your expenditures and, to track your income, track your expenditures, and from that, knowing the things that you need, separating kind of the things that you need from the things that you want, meaning, yes, you need a new car, for example, or a better transportation, but you don't need to have a brand new $40,000 vehicle. You can get by with something significantly less. You get the idea. And from that, this is from that, the last point here is to connect money management activities with savings for personal financial goals. This is where that linkage, where you bring these things together, to get to help you to arrive at that point which you're trying to get to, meaning that financial security, if you will. Okay, anyway, onward. So again, learning objective 1 was identify the main components of wise money management. Money management is specifically day-to-day financial activities necessary to manage current personal economic resources while working toward longer-term financial security. In finance, there are what are called money markets and there are capital markets. Money markets are anything up to 1 year. So when you think money, think about something very liquid, something that that you can easily get your hands on. So these are very short-term instruments that are out there. So we're looking at the very, very near term, but to do what? In the service of going longer term, for these long-term financial assets and developing your long-term financial security. Again, we're looking at the daily spending and saving decisions, and this is the expression, if you watch your pennies, the dollars will take care of themselves. So if you stay focused on those things that are in front of you, things that you can kind of easily manage or readily manage, if not easily, at least you're able to manage them in a much more efficient manner than longer term things. It's what I mean by that is that, yes, you can make a decision about whether or not to buy that cup of coffee. Say, well, no, I'll make it at home and I'll save myself $1.50 or $2. So you're making those decisions all the time. And that's, again, in the best interest of what? Looking long-term for your own long-term financial security. So onward. Components of that money management: 1, storing and maintaining personal financial records and documents. So keeping track of these things. Keeping track of those expenditures. It's something that's very important, whether you're talking about diet or anything. If you can track things, if you can keep track of exactly what's going on, or as close to as you can to what's going on, you can develop a sense for things. And so that's 1, storing and maintaining personal financial records and documents. 2, creating personal financial statements. And that's tracking these things in a very, your expenditures, etc., in a very formal manner, meaning you can do them on Excel, the spreadsheets. You can actually just track on a piece of paper if you want. Have a notebook tracking your expenses. You can create financial statements, balance sheets, and cash flow statements of income and outflows. And so basically what we're saying is a balance sheet, again, is a snapshot of where you're at right now. Your assets, what you own, your liabilities, what you owe on those assets or whatnot, how much you owe on that mortgage, and then whatever's left over is your equity. It's your ownership of whatever, again, that we're talking about, okay? And versus cash flow is tracking your income. Remember, income is money that you earn over a period of time, the income matching it with outgoing expenditures over that same period of time. So and then whatever's left over, revenue minus expense is profit, if you will, in a business sense or an accounting sense. Same thing for individuals. Your revenue, your income minus your expenses, whatever's left over, flows from there into your balance sheet in terms of increasing your wealth, the amount of wealth. So that's step 2. Step 3, creating and implementing a plan for spending and saving, budgeting, very basic budgeting, meaning very straightforward. You can't always plan for everything because you don't know. We don't know what the future holds for us, but it doesn't mean that we shouldn't try to take our best guess at doing this. And what I mean by that is that we can pretty much guess that if we're driving to work every day, we know how much gas we're going to be using. So that would an expense associated with the driving in terms of the gas. We can pretty much track that. Prices go up and down. But we can probably get a pretty good idea about how much we're spending. If we're spending $20 a week or $50 a week, even if gas prices go up, maybe spending $30 or $75 a week. Anyway, you get the idea, keeping track of things that way. So the system for personal financial records, these are things that all it takes is a folder, something that you can set aside, or even a notebook, if you will. So provides a basis for handling daily business affairs such as bill paying, planning and measuring financial progress, completing required tax reports, making effective investment decisions, determining available resources for current and future buying. So this is kind of boots on the ground approach, if you will. I mean, you want to track as much as you possibly can, especially when you're starting. Once you get moving along the road here, you probably would be doing less of this because you know pretty much what your expenses are, what your income is and what your expenses are associated with it. But it's a good idea to try to get a handle on it, and it's certainly always a good idea to have some system set up, whether on your computer or whatnot. And we'll talk more about that going forward. So records in your home file, these are hard copies, if you will. And some of this stuff actually it's in the process of changing. Personal employment records, always a good idea to have some of that, at the ready in a safe place in terms of, filing cabinet and whatnot. as much of the money management records that we had already mentioned as possible. Tax records, for sure, you want to hold on to those for about 7 years. Financial services records, credit records, consumer purchases and auto records. You definitely want to, hold on to your title, and you want to hold on to your warranty information for appliances. You buy housing records in terms of mortgages, or in terms of your rental payments, and so on and so forth. Insurance records, keeping a copy of your insurance policy, for example. Investment records at least have some idea about where they're at in terms of if you have, they typically issue quarterly statements on investments in terms of like mutual funds, and we'll get into that. Estate planning and retirement records, that would come into the idea of having a will, or having a will would probably be a very good example of this. So these are things that you want to keep on file, hard copies, if you will, at home. So safe deposit boxes, these are some things that we don't really think about, but there are some things that should be kept in safe deposit boxes, and there are a list: birth certificates, marriage and death certificates, a list of different accounts that are important to you, financial accounts, citizenship papers, military papers, adoption, custody papers. These are things that are concerned to some people, not everybody, but all this is an umbrella trying to get, trying to cover as much of the waterfront as possible. Serial numbers and photos of valuables. This is something for insurance purposes. If you do have valuables, if you do have something that's a family heirloom. You definitely want to take a picture of it, and any kind of a record of any kind of a serial number that might be associated with it or whatnot would be very, very helpful. And these are things that we want to keep in a safe deposit box. CDs and credit and bank account numbers, mortgage papers, titles, list of insurance policy numbers, stock and bond certificates, and a lot of that stuff is antiquated, but electronic meaning, but there are still some stock and bond certificates that are hard copies, coins and other collectibles certainly, and it's a good idea to keep a copy of your will. So if you don't have a safe deposit box, it's something to consider. At least consider going forward, if not right away. What to keep in safe deposit box or home fireproof safe. Again, walk through that list that we had talked about before. Any kind of papers that you need to hold on to, or you need to be able to reference. Nothing worse than losing a wallet and finding out you don't have your credit card information. And it's just a bear trying to track down this information. If nothing else, what I would suggest, and it's you can lose your phone too, but take pictures of some of these things and maybe save them on your Google Drive or something. Anyway, it's just a thought. So onward. Records on your personal computer. Again, there's an asterisk here, keep a backup, meaning I have my backup plugged into my computer. I've got an older computer, so I'm a bit concerned about that. But current past budgets, so you can track things, summary of checks written, other banking transactions. A lot of that is online, available through your financial institution, but it only goes back so far. Not that you need to go back terribly far, but just it's nice to have it at your fingertips, if you will, on your computer if possible. Past income tax returns, if you have TurboTax, etc. Account summaries, performance and results of investments, those are for tracking purposes, and perhaps a digital version PDF file, for example, of wills, estate plans, and other documents. Records on your personal computer. This is, I guess, taking a step further. Computer, tablet, or phone, rather. Scan copies of documents, as I'd indicated as well. You have to be careful, of course, with numbers, with account numbers and with passwords and so on and so forth. But it's probably not a bad idea to keep at least some tracking here, where you can go from wherever you have this to another location where you might be able to find it. So these are all good things. Then taking that a step further, keeping your own record safe, download copies of all statements and forms to local storage and use logical file names and folders, backup files externally or online. A lot of that's gone to the cloud, if you will, but still, you save it on your computer if you have memory. Memory is very inexpensive now. You can always do that. And passwords are very, very important, of course, and to have complex passwords in order to keep people from hacking into your accounts, etc. Scan copies of the documents again, and be sure to, when you erase files, not just erase them, but to completely erase them, to go back and do that, right? What not to keep, what to shred. It's an interesting list. Wastebasket, receipts, small, things that don't have your name on it, wastebasket. Things that do have your name on it, you can shred, and you can always empty that, into the recycle bin. It's just a common sense type things. Shred things with PII, personally identifiable information. Very important. So how long to keep your records? This is always good. Birth certificates, will, Social Security information, of course, you keep that forever, as long as you're around, and then some. If you have a deceased spouse, it's important to keep records on death certificates or parents or whatnot. Anyways, personal property investments, as long as you own them, of course. Documents, purchase of real estate, that's, again, you hold on to that for forever. Tax return 7 years, and it's on here, it says 10 years is better, and that's for your own just your own well-being, is to hang on to things. Don't have to do it forever, but 10 years is very, very good number. You don't have to. 7 is fine, but if you can hang on to for 10 years, you're better off. Objective 2, create a personal balance sheet. Now we're getting into the nitty-gritty. The benefits, of course, is that you get an opportunity to recap your current financial position in relation to the value of items you own and the amounts you owe. And so being able to really establish where you're at and measure progress again toward your financial goals. Where did you start with this and where are you at now? As you're kind of moving along, as you're tracking along, you're able to do what? Keep track of this and how you're tracking toward, again, those financial goals that you want, towards your $1 million, if you will, and maintain information on financial activities. And this is, again, you have expenditures that are way out of line for 1 month, and it's nice to know why that was the case. It's not only nice, it's very important. Meaning, if they were way too high, or vice versa, if they're way too low, you want to see, oh, is this going to be a trend that's going to go forward, or is it a one-time thing? So all this is very important. Okay. Lastly, provide information for preparing tax forms or applying for credit. Always a pain. Absolutely important. For tax returns, understanding what you have in terms of deductions, expenses, medical expenses on a personal note, in particular, just various things along those lines. Tracking your mortgage expenses, and there are some items that you want to really keep close tabs on. And we'll get into that when we go forward. Also, applying for credit. Applying for credit is a pain. Your lenders want to, of course, know everything about you. They want to know what your income is. They want to know who you're working for, how much you're getting, again, your income-wise, what your expenditures are, what your balances are on your credit cards, what your ratios are. We'll get to that shortly. You get the idea. Balance sheet, again, financial statement that reports what an individual or family owns and owes as of a specific date. A snapshot, if you will, also called a net worth statement or a statement of financial position. So on the left, we're looking at items of value, the assets, what you own, minus the amounts that you owe on those assets, what you owe in total, and whatever's left over. So your assets are the items that you own versus what you owe on those items equals your net worth, your wealth. Remember, we talked before about that. Your income flows through to this wealth. This whatever's left over is your wealth. All right. So components of the balance sheet, one list items of value. So we're looking at on the left-hand side, if you will, or on the top, we're looking at the good guys, the liquid assets, the cash that you have, financial assets, real estate, personal possessions, investment assets. And step 2 is determine the amounts you owe, or the liabilities. At less than 1 year, you break it up. Less than 1 year versus long-term liabilities, meaning what you owe, kind of in the immediate versus what you owe going forward that you know of, your longer-term liabilities, what you owe on the house, and so on and so forth. If you have a mortgage, and from that you get your net worth, or you get your equity, your owner's equity is the expression. So again, your net worth is assets minus liabilities equal your net worth, what you are worth when you subtract out all of your liabilities from your assets. Measurement of current financial position. Net worth is not necessarily cash available. It's not necessarily liquid, meaning that you may have your home that we talked about before that's worth $100,000 and you owe $80,000 on it, and your net worth, or your whatever's left over, is $20,000, but it's not readily available because in order to get your hands on the $20,000, you have to either do some refinancing or to sell the home. Okay, so insolvency. This is another concept we'll get into, is your inability to pay debts when due. Liabilities far exceed your assets, meaning you cannot service your liabilities. You don't have enough income to cover the cost of what you're what you owe, and this happens, and that's insolvency. It has to do with solvency, meaning how solvent you are, how liquid you are, how much cash you have on hand to meet your debt obligations, your bills, etc. Okay. So quickly, a sample balance sheet. What we notice here, this is top to bottom. We're showing the assets on the top. And you'll notice that on the very top, it's the most liquid assets. These are the assets, the money, closest thing to money that you have. Checking account balance, that's cash, right? Same thing. Checks and cash are the same, meaning so far as our concerns, liquidity purposes. Saving, that's a little less liquid, meaning it takes a little while to get your hands on what's in the saving account. And the cash value of your life insurance, that's a little longer out there, but if you had to cash out on your life insurance, there would be something left over. Again, we'll get into that a little bit later in the course. Current market value of your home, these are all on the plus side, all positive things, if you will. Personal possessions, the market value of your automobile, furniture and appliances, home entertainment system, home computer, jewelry, and that brings up the total. And your investments, these are longer term yet, retirement accounts, mutual funds, etc. Your total investments, and this totals out to about $259,000 from what I can see here. Point being, again, these are on the plus side. Liabilities, this is what you owe in relation to those assets above, etc. And the idea is you have medical bills, charge account and credit card. So this is the very liquid stuff, what you owe immediately. Balance due on auto loan, current liabilities versus longer term liabilities. Again, mortgage, long term. Home improvement loan, again, long term. Student loan spreads out over more than 1 year. These are long term liabilities, and your total liabilities amount to $94,560. Your total liabilities rather about $100,000, and your net worth again are your assets minus your liabilities. All right, this is a balance sheet. This is a snapshot of where you're at right at this moment. Versus ways to increase your net worth, increase saving, reduce spending, increase the value of investments and other possessions, reduce amounts owed. So these are all things toward what? You're trying to increase your wealth, increase your net worth, to grow your net worth. So now we're on to the cash flow side. This is that income that we talked about before. Cash flow statements is equal to personal income and expenditure statement. There are a lot of different ways you can refer to it. It's often called the income statement. Summary of cash receipts and payments for a given period. So on the very bottom, total cash received during a specific time, remember your income, over a specific time, cash flow over that, outflows rather, your expenditures over that same time, and whatever's left over is either going to be a surplus, so profit, or a deficit, a loss. So it's either a profit or a loss. That's what's left over. What's left of your income, if you will, after your expenditures. So again, the cash flow statement, inflows and outflows. Step one is record the income, of course, because you have to be able to pay for whatever it is that's in the outflow side. So the net income from your employment, net pay after, withholding taxes, etc., saving and investment income and other sources. So these are all on the plus side, stuff that's flowing in. Next are your outflows, your fixed and variable expenses. Fixed expenses are things that you know are going to be, that's what what it's going to be going forward. Your mortgage payment, your car payment, those are fixed. You know that they're going to be the same every month after month, versus variable expenses. The price of gasoline, so the cost of your fuel is going to go up and down. Typically up, but also can go down. So you get the idea. Those are variable expenses. And lastly is determine your net cash flow. So income minus expenses, revenue minus expenses, however you want to call it. And then whatever's left over is your net cash flow. If it's positive, it's a surplus. If it's negative, it's a deficit. So here again is the cash flow statement. Your income, again at the top. Again, you go from the more liquid the more liquid your income is on the very top, and there's your salary less the federal income tax, the deductions and withholding taxes, federal, state, Social Security, Medicare, all this stuff comes out before payroll taxes are referred to, and from that you have your net pay for that period. And the next piece, that interest on earned on savings, whatever you have in savings, how much income, if you're going to be recognizing that income in this time frame, then that's where it comes from, versus the outflows, the negative, the bad boys, if you will, the expenses that are shown. Fixed expenses, again, rent. Every month you're paying $11.50 according to your contract that you have. Your lease, it's saying $11.50 a month. Variable expenses, food at home, that's going to go up and down. It's going to change. Those are variable expenses, and so the total outflows, the difference between the two, would be your surplus or your deficit, again, on a monthly basis, annual basis, however you're tracking. And then what it is you're going to do with that surplus. Emergency fund savings is short-term and intermediate financial goals, savings and long-term financial security. So this is funny, but this is kind of where you pay yourself, whatever's left over from your paycheck, if you will. It's, even though they say you pay yourself first, it comes out last, but you are always with an eye on, you want to pay yourself first. You want to give yourself a certain portion of that check. Okay. So ratios for evaluating progress, these are ratios. These are rules of thumb. So debt ratio is, again, we'll just walk through these very quickly. Liabilities divided by your net worth. So your liabilities amount to $25,000. Your net worth is $50,000. That gives you a debt ratio of 0.5. The lower the better. So if you had, rather than 0.5, if you had $10,000 in expenses, for example, or $2,500 in liabilities, rather, it would move the 0 over 1, so it would be 0.05 would be your debt ratio. Okay, current ratio. This is all accounting terms. So we're looking at the near-term expenses when we're looking at a liquidity ratio. So we're looking at your liquid assets divided by your monthly expenses. So your liquid assets amount to $10,000. Your monthly expenses are $4,000. That's 2.5. In this case, you want it to be as high as possible. I mean, it's not. There's reasons why you don't want it to be too high, but we'll talk about that as we go forward. If it's too high, for example, it means that you have too much cash. You're leaving too much cash on the table, if you will. Debt payments ratio, monthly credit payments divided by take-home pay. So in this case, your credit payments, credit card payments, etc., $540 a month versus your take-home pay or over your take-home pay of $3,600, 0.15. Most financial advisors recommend a debt payment ratio of less than 20%. So this isn't bad, is the point. Servicing that debt, how much you're paying on your credit card, etc. Savings ratio, amount saved each month divided by gross income. And again, in this case, $648 a month divided by the 5,400 gets you 0.12. Financial experts, again, say monthly savings of 5 to 10%. Paying yourself first, 5 to 10% per month. It doesn't sound like a lot, but it is. And it adds up very quickly too going forward. So develop and implement a personal budget. Budget equates to a spending plan. Expense budgets, they're referred to also. They're capital budgets, but we'll just look at, just consider what goes out versus what comes in. It help you to live within your income, spend money wisely, reach your financial goals. These are all tools to help you live to help you achieve your financial goals. Keep that in mind. Budgets are no fun because they're very restrictive in some cases, but they're also a very good gut check because we can't spend like the government spends, where we can't continuously overspend every year, running deficits and so on and so forth. We can't do that. We cannot operate that way, nor can the government in the long run. But these are things to be considered if you take more finance courses or economics courses. So prepare for financial emergencies. It's always good to have that cushion. Develop wise financial management habits. Always do that gut check. Opportunity cost, opportunity cost, opportunity cost. You want to consider these things. Is it worth spending that extra $5 or $500, whatever that amount is? Does it make sense? Does it make financial sense? Or are you wasting your time on something that's so insignificant? these are all things that we have to consider. Okay. Okay, so plan for effective budgeting. We're getting there, folks. I'm running a little slow on this, but plan for effective budgeting. Step 1, set financial goals. Step 2, estimate income. 3, budget an emergency fund and saving. Step 4, budget fixed expenses. 5, budget variable expenses. 6, record spending amounts, keeping track, right? 7, review spending and savings patterns. This is very tough to do, but these are all essential to do what? In reviewing your financial progress, to see how you're moving toward, your objectives. And lastly, again, you always have to revise. You have to revise goals, and based upon your spending and your income, you're always checking these numbers around. So common financial goals, very short, very straightforward. A single person, complete college, pay off auto loan, less than 2 years. Must be nice, but you get the idea. These are goals. They're not that you're necessarily going to be able to achieve them, but you'd like to, right? So you kind of set the bar high and you shoot for that. You figure out some way to do it. It also justifies in your mind to say that you want to pay something off that keeps you from spending it on something else. So these are all these things that we're trying to, 1, to trick ourselves, 2, to get ourselves disciplined. Intermediate goals: take a vacation to Europe, pay off education loan entirely, attend graduate school. Long-term goals: over 5 years, buy a vacation home in the mountains. Sounds good. Provide for retirement income. Always important. This is where, remember, providing for retirement income, paying yourself first. That's where that comes into play. Married couple with children, without children, with children rather, the things that go along with it. These are pretty common. Again, they're pretty common goals. Some of them are rather high. The bar is kind of high, but nonetheless, they're important to set the bar a little higher than perhaps you can reach, because that's how you get there, is by trying. That's very important. That's what budgets are really all about, is setting goals so that you can try to hit the mark with those budgets. Setting goals for yourself. Sample budget, very straightforward again. So you're tracking, 1 month versus another month, and in this case, what we're looking at is your budgeted amount versus what you actually paid for that month. And the first column are the dollars. The second column is the percentages. So you're breaking out your inflows and outflows based on a percentage of the total, if you will. So there's your budgeted dollars amounts for your salary, and so that salary would amount to 100% of your total budget, right? Whatever's coming in. And again, you walk down through, and the top line, of course, is your income that's coming in, and projected outflows, where you're going to be spending this on, because you're moving it to some place. Meaning you're either going to move it into, when I say moving it to some place, it might go into a cash account, doesn't matter. But you're going to be moving it you're not going to be walking around with your paycheck for a month and not cash it or not deposit it or something, doing something with it. So that's what this is all about, is walking through those steps. And what we're doing is we're comparing the budgeted on the left with the actual on the right-hand side, and then of course at the last column are the variances, meaning did you beat what you forecasted in your budget, or did not set enough money in that pot aside to cover that? Point being, again, is that you're trying to track these things in order to do what? To try to figure things out kind of going forward. So you're looking at your fixed expenses, and so again, fixed expenses are fixed. So it's always at your variable expenses where things get kind of cockeye. Hopefully not in your fixed expenses, but in your variable expenses. All this is very intriguing, very, very important. So typical budget allocations. This is kind of a breakout of what's kind of suggested, if you will, or what's out there, based on tracking through our buddies at the Bureau of Labor Statistics. Housing, for, we'll just say, it looks changes from 20% up to like 35%, for example. How much we spend on transportation, food at home and away from home, clothing, personal health care, so on and so forth. And of course, example would be for the personal and health care, including child care, 3 to 5% for a student, 3 to 5% for working single, 4 to 10% couple with children under 18. Boom. Of course, the healthcare costs go up along with the child care. And then what you'll notice is a couple over 55 with no dependent children, that's up to 6 to 12%. And that's because of what? Healthcare costs. Healthcare costs continue to rise as you grow older. So anyway, and also what's interesting is on the bottom is that the savings piece. It varies significantly, but the idea is that in your prime earning years, if you will, you want to try to save as much as you can, so that for what in your as you approach your golden years, you won't have to save quite so much, or you will be able to continue on in your retirement golden years again in the manner in which you would like. So money management system, or the SWOT analysis. Anyway, the strengths, weaknesses, opportunities, and threats, we all have been, or not all of us, but these are things that we run through in our heads all the time. Saving 5 to 10% of income. So these are internal or personal factors. You're informed on personal finance topics, no credit card debt, flexible job skills. These are all your strengths versus, there are weaknesses, high level of credit card debt, no emergency fund, automobile in need of repairs, low current cash inflows, listing your weaknesses. Again, opportunities, phone apps for monitoring finances, things that can kind of remedy some of these weaknesses or address some of these weaknesses. Part-time work to supplement income. You're not earning enough money, so what do? You go out there and take on another job. Two things happen with that. One is that you're earning more income. Two, you're not able to spend if you're out working, right? So this is kind of a double hit in a positive way, opportunistically, and so on and so forth. Always trying to figure out some ways in order to reduce, the downside, if you will, your weaknesses. And the threats, of course, they're always something lurking. Lower market value retirement fund, possible reduced hours at part-time job, reduced home market value, increased cost of living, inflation. These are always things that are on the horizon. They're always things to consider. Characteristics of a successful budget. Good luck with that. But it's well planned. The reality is that budgets are in many ways, forecasts are pretty much useless, but the good thing about it is that they get you into that mindset of tracking your expenses. So that's where this well-planned part comes in. And realistic, the more of your spending that you can get under control, not to reduce or get rid of necessarily, but to have an idea of that's going on in terms of your budget. The more you have a handle on that, the better off you'll be. And it also it allows you to be more flexible, because if you have an idea of what's coming, you know that there's going to be some big expense coming down the road. You have to you're going to have to pay to get your car serviced, and not just an oil change, but you're going to have to spend $1,000 on your car. You know it. So that this provides you the flexibility to deal with that, meaning you know that it's coming, so you can kind of plan for it. Back to that well-planned piece, and again, it has to be clearly communicated. And who's the audience? You yourself. You are the audience. So it's very important. Selecting a budgeting system, mental, physical, written, computerized. All these are the same thing, really, is what it comes down to. The mental budget, if you are very limited in terms of like what your expenses are, and very straightforward, you can pretty much track these things. You know what you're earning, and you know what your expenses are on a monthly basis. It doesn't mean you shouldn't make it a little more robust, more complicated. I hate to use that term, but But at least if you can keep on track mentally with the budget, then you're ahead of the game. Physical budgets, again, these are hard copies and tracking expenses and so on and so forth. Written budget, where you actually put pen or pencil to paper, and you track your expenses and track your income and walk through it and to see what it is. You're guessing what your expenses are going to be next month. And the last one is a computerized budget, very, very simple with Excel to set this up, Microsoft Excel. And it's something where on the left-hand side, you have your budget. Again, as it showed a few slides before, you have your budget. Next are your actuals, what you actually, the cost that you actually incurred, and then the variance, the last column over. And that's when you have to explain to yourself, why was it that you spent 15% more on gas last month? Well, gas prices went up a bit, but also because of work, I had to drive quite a bit more. I also had to take, I had to take my grandparents to their medical appointments, and there was a lot of driving involved. Things like that, being able to identify these things is very important. So the last learning objective 4 is we're connecting these activities with trying to get them to our personal financial goals. And balance sheet, again, is where a snapshot of where you are. Your cash flow statement is what your spending is, what your income is, what your spending is over a specific period of time. Your budget is kind of bringing this together in terms of planning, spending, and saving to achieve those financial goals. Meaning, again, what you're budgeting, what you're planning to spend, what you actually spent, the variance between the two, and to go from there. That's budgeting, what it comes down to. So changes in net worth result from cash inflows and outflows. If your outflows are greater than your inflows, it's a good thing. It's a bad thing. Outflows or exceed your inflows, rather, is a bad thing. You're drawing from savings or borrowing in order to subsidize, to make up for the difference. Again, the result is you have lower assets or higher liabilities. And if your inflows are greater than your outflows, this is ideally a surplus. You put money into savings or pay off debts. The result is that you end up with what? A higher net worth. So you're growing your wealth. You're growing your net worth, increasing your net worth. Selecting a saving technique, write a check each payday. This is, again, paying yourself, or electronic transfer and deposit into a savings account. Use payroll deduction to deposit a certain amount into saving, direct deposit again. Save coins or spend less on certain items. Track your expenses. And if you can cut costs, cut corners somehow, some way without harming yourself, you'll be that much better off. Whatever you can set aside, save yourself, you will be better off. And you can go through these. These are exercises, and oftentimes they're just mental exercises, because you have to consider what the thing that comes up over and over again is opportunity cost. If I want to buy that, buy that shirt or that whatever it is, the garment that you want to purchase, it costs $50. Do I really want it? Yes, I really want it. How much do I really want it? Do I want it now? Do I need it? I don't really need it quite yet, but I could get it in 6 months from now, but the price might go up. Yeah, it might, but maybe not. So these are things that you have to walk through, these mental gymnastics, okay? You have to go through and weigh the different options that you have. So calculate savings amount, convert savings goals into specific amounts. Again, that we'd already talked about that. Using savings and investment plans to grow your money. Use time value of money to calculate progress toward your financial goals, the things that we've talked about before, where you're setting aside what's going in. So if you set aside $50 a month, remember, you're compounding interest. Whatever you can add to, that's going to increase your principal, so that the next time as you're going forward, that part is going to be folded into that interest. So if you're getting 10% interest and you add an additional $50, there's an additional $50 to start from. That's going to be what? Earning 10% interest. You get the idea. So using saving to achieve financial goals, and these are specific things that I want you to go through and just to consider. And this is also the beauty of compounding, is that whether it's 7%, 8%, 12%, the higher the percentage, of course, the better off you'll be, but it's just the idea. How much you're setting aside. Again, it's $6,000 that for the first one, and you're not going to be adding anything to it. 10 years time, it's going to be pretty close to double, right? Rule of 72. 72 divided by 7% is a little bit less than 10, or it's a little bit, a little bit more than 10 rather. So it's not quite double, but it's heading there. Saving for retirement expenses, and this is adding every year, depositing $2,000 per year, you're getting 8%, and how that grows over time. And save for down payment to purchase a home, deposit $200 every 3 months at 12%, 10 years time you have $15,000. So this is the idea, is that the beauty again of compound interest going forward. Very, very important. So again, to summarize, identify the main components of wise money management, coordination of personal financial records, keeping track as you're kind of going forward. Excuse me, and budgeting activities, and organized system providing easy access and security. So you need to have these at your fingertips, or very relatively close to, but at the same time you want them secure so other people can't snoop, which people tend to do, right? Learning objective 2, create a personal balance sheet, cash flow statement. Balance sheet again is a net worth statement. Assets minus liabilities. Whatever's left over is your net worth or your owner's equity. Cash flow statement, this is income. Personal income minus expenditures, or income minus expenditures or expenses equals revenue. So revenue minus income is equal to profit or loss. So if you have a positive number, there's a surplus, there's a profit. If you have a negative number, that there's a deficit or there's a loss, if you will. So that's the income statement or the cash flow statement. And this walks through the 7 steps in the budgeting process. Set those financial goals. Estimate your income. That's, you don't know what the future holds, but you do the best you can so far as estimating what your income is going to be. Try to set aside, pay yourself first. Budget an emergency fund and savings. Pay yourself first. And if you're being too aggressive so far as savings is concerned, you have to go back and reduce it some. Maybe you can even add something to it, but always remember, pay yourself first. You budget first your fixed expenses, things that are not going to change, your mortgage, your insurance payments, your rent, however you want to, whatever you want to that fit the bill, loans for vehicles and etc. Budget then variable expenses, things that change on a monthly basis, if you will. And you try to record what you're spending. Of course, you need that anyways to track this, but you try your best to record what you're spending on specifically as you're going through. And so then the last item, of course, is review that spending and saving pattern. Is there a variance in terms of your variable expenses? Where are those variances specifically? Why was it that you spent twice as much on gasoline, gas for your vehicle this month than you did the previous month? Those are the things you're looking at. Okay, lastly, connect money management activities with savings for personal financial goals. The basis for achieving that financial security is the relationship between the personal balance sheet, again, that net worth statement, your cash flow statement, and your budget. So combining the 3 of these together, your balance sheet, your cash flow or your income statement, and the budget, how things are varying on a month-to-month basis, year-to-year basis, however you want to do it. And you want to use, again, that time value of money calculation to determine the increase is the amount of your saving and the amount you need to reach those future goals. That's what this is all about, is trying to get to that.